Hey everyone, welcome back to episode 6 of the Hendriks Experience. We've got back today Tyler Hibbs, mortgage broker at the Hendriks Business Center, downtown our office, 145 King Street. And today we'd like to talk about, well, mortgages. We always talk about mortgages, but today I think that one of the biggest topics is someone's getting a new mortgage, they're getting a renewal on the mortgage. What do I do? There's so many choices, so many options out there. Tell us a little bit about that, Tyler.
Yeah, absolutely. Well, first off, thanks for having me again.
Our pleasure.
In terms of mortgages right now, we're seeing lots of action in terms of renewals. The biggest thing is people up for renewal.
All right, so let's talk about renewals then.
Yeah, let's focus.
Someone comes in, they contact you,
Yep.
and they're like, my mortgage is coming up for renewal.
Yep.
I owe X amount of dollars on it. I had X interest rate, which is likely super low from what it is today, unfortunately.
Yep.
And the question is, what the hell do I do?
Absolutely. The sticker shock out there is real. People are locked in for, most people do a good portion of people do fixed rate mortgages. They're up for renewal. Obviously, cash flow is going to change significantly, right? And that's like the biggest thing. People
now, when you say that cash flow is going to change significantly, you're referring to what their payment was compared to what it's going to be today.
Absolutely.
And that difference and how that's going to impact themselves and their lifestyle.
Absolutely. Their amortization schedule is still set to be the same. So if they were on to keep their basic expectation of when their mortgage free is going to be the same.
Right. And when you say amortization, just for those who maybe don't know, generally you either have a 25-year amortization or a 30-year amortization.
Absolutely.
Correct?
Absolutely. So if they're up for renewal, let's just say they bought their first house, 25 amortization, they're up for renewal 5 years later, right? So now in order to remain on that same amortization schedule, and rates are obviously higher, their payments will increase, right?
Right. So if they want to continue at that 20-year left on
Correct.
their mortgage, then they're going to have a higher payment.
Absolutely.
Now, could they also choose to reset that amortization at 25 years? Is that possible for people in order to have their payments a little bit less?
Absolutely.
To kind of cushion that impact of the higher rates?
Yeah, and even some cases they can push it to a 30-year amortization. So really that becomes obviously interest rate is super, super important. But most of the time when you're talking to people and they're worried about their payment, it's actually cash flow, right? So when we're talking about options, extending the amortization actually is one, right? So the benefit of that is that, like, obviously I've given you more time to pay back the same amount of money. Well, therefore your monthly payment is less because I'm giving you more time to pay it back.
Right. So the flip side to that is you were at 25, you've gone down to 20. Now you're bouncing back up to 30. It's going to cost you a lot more interest costs though over that time, right?
Absolutely. So the downfall of that option is, again, the positive is the cash flows obviously the cash flow has increased because your mortgage payment is lower than what your obligated payment could be if you stayed at 20 years. But yes, you're borrowing that money for a longer period of time, which ultimately means that you're going to be paying more in interest. But there are several ways to cut down on that, right?
All right. Well, let's talk about those ways.
Absolutely. So you can have your cake and eat it too. You can lower your monthly payment, your obligated monthly payment, right? Now, there's ways obviously to cut back. So if you extend it to a 30 amortization, when we talked about, lenders typically have 2 to 3 different ways to shave off the interest. The biggest one that people know about is your prepayment, meaning that, okay, if I do a mortgage I buy a house for $500,000, I have a mortgage for $400,000, you can put 20% of the original mortgage balance directly against the principal. Okay, some lenders allow you to do it to the anniversary date. Some allow you to do it to like every single day. It has to be a minimum of $100.
Right. So that gets your monthly payment down. But again, you have to have that cash for that lump sum payment that you're referring to, correct?
Correct. So that actually doesn't change your cash flow. Okay. I always explain it like you buy a vehicle. Okay. Someone buys a vehicle for $50,000 and you go and you put $20,000 against that vehicle. So now you owe $30,000. Guess what? Your payment is still the same. Still the same. It just changes the amount. Like when you're looking through your monthly payment every single year and or every single month and you check on your online banking, you say, okay, I made $1,000 payment last month. And $900 of it went to interest and $100 went towards.
Yeah, that can be a little depressing sometimes when you get that mortgage payment statement. And yes, it's mostly interest.
Yes, but if you do the lump sum, you will see it change. More will go towards principal than interest.
And there is other options. You got a lump sum. You can double down on a payment itself.
Correct. So you can increase your monthly. You can increase the payment, right?
So if I'm hearing you correctly, it sounds like it's not a bad idea in certain situations that you're going to stretch out the amortization in order to get a lower monthly payment, yet at the same time, try to sock some of that cash away so you can make an extra principal payment.
Absolutely. So if you're saving in cash flow, if you're saving $200, $300, $400 a month cash flow by extending that amortization. If you're regimented enough, or the client are regimented enough, we say, listen, like save that additional cash flow and just do a lump sum against it. So you're not extending that amortization. Like you're putting money directly against the principal, which will lower the amortization.
Right.
Another big one is payment frequency, right? Which is very, very simple to do, and it changes your amortization drastically. So basically what that means is that you can choose to go accelerated or traditional, right? So you can do biweekly payments or accelerated biweekly payments, okay? And I'll explain kind of like the drastic difference of that is basically if you're doing a 30 amortization, but you opt to basically do accelerated payments. Okay?
Yes. So what you're actually doing by doing that accelerated biweekly payment, you're actually making a full month's payment extra every year. Is that correct?
Correct. One full, right?
Yeah.
So I mean,
And that's going right off your principal.
Absolutely. Yeah. So exactly. So what basically happens is a standard biweekly payment is your monthly times 12 divided by 26, because we paid 26 times throughout the year, right?
Yeah.
Your accelerated biweekly payment is basically your monthly divided by 2. It doesn't mean that you have less payments. It's just the payment itself is actually slightly higher when it comes to accelerated payment because it factors in, basically those 2 extra payments throughout the year.
Yeah, and I would say a lot of times people aren't really going to miss that extra, right? Each month.
Yeah.
They just tuck a little bit more down on it. I know times can be tough and it could be a bit of a stretch, but by doing that, you'd be amazed. Like, what is your amortization? I think I know, but to share with everybody else, if you have a 25-year AM and you do that accelerated payments, what does your amortization actually go down to overall?
21.8 roughly.
21.8.
Yeah. So if you do accelerated versus standard, you're automatically dropping the amortization from a 25 to 21.8 year. And the difference on a $500,000 mortgage at standard rates right now is a difference of like $113 biweekly. So, you kind of
the 113 biweekly extra that you're going to put in.
Correct.
Right.
Like if you were able to do that for the lifestyle of the mortgage, drops it quite drastically, right?
Absolutely. And how much you saving quite a ton of interest. Approximately how much?
Yeah, on standard rates right now for like an insurable purchase, it's about $63,000 over the lifespan of the mortgage.
That's incredible. That's a heck of a lot of money.
On a 30-year amortization, it drops it from a 30 to about a 24.8 amortization, and the change on that is about on standard rates right now. Conventional with one of the big banks is about $103,000 and change, depending on the rate, obviously.
Wow, incredible. So 3+ years of saving payments or 5+ years of saving payments.
Yeah, and obviously just the interest as well, right?
Right.
So lots of ways to kind of have your cake and eat it too. To lower the monthly, lower your monthly obligated payment. That's the key, right?
Let's jump into the terms and the rates themselves, right? There's a lot of choices out there. You've got your variable rate mortgage, which is still hanging pretty high on the variable. And then you have your closed term mortgages of 1 to 5 years. That's generally most of the terms are going to be in options, correct?
Yep.
Now, of course, you have an open for certain situations. Maybe you share a little bit about that as well.
Yeah, for sure. So product and suitability is extremely important, right? So we're not going to do a 5-year fixed mortgage for someone that's someone that does construction or flips homes and he's going to sell this place in years, right? Your interest rate differential calculator is what banks basically use to calculate.
Okay, that was a big long word very quickly.
IRD, interest rate differential. Right?
Yeah,
and that's
share with everyone what the IRD is.
It's basically a calculation that banks use to figure out what your penalty would be on a fixed rate mortgage. Okay, on a 5-year fixed, the average IRD is 4.5% of your balance. Okay, it's a big number, which is why suitability is so important. Now, most lenders allow you to pick up that mortgage and port it and move it to somewhere else.
Yes, so
right?
you're going to carry those same terms to the next property.
Correct.
You can also port and increase.
Yeah.
Or so if you are moving up, or port and decrease, and then they'll make an adjustment to the IRD, right? Or to that.
There might not be any.
May not be any.
Yeah, depending what the prepayment. So if you're allowed to do 15 or 20%, if you're staying within that bracket, higher or lower, then you'd be fine.
Right. I know we've talked in the past about going with a 5-year term. Gives you that ability. You may not necessarily first choose a 5-year term closed right now, since we're looking towards a downward trend in interest rates. At the same time, a 5-year at a lower interest rate is going to allow you the opportunity to qualify for more money.
Yes.
Is that correct?
Yes. So we qualify it's a federally regulated rule that we qualify for 2% higher than whatever your actual rate is. So if you are looking at a 5-year fixed mortgage versus a variable, for example, there's a huge delta between the two. So if you're qualifying for 2% higher than whatever those two rates are, you will have more purchasing power on a 5-year fix versus a variable, even though it might not be the right product, right? So again, that's why like suitability becomes so important, that we know like what's the end goal with the product.
Absolutely. And jumping back to what you mentioned about the qualifying, the 2% higher, that has actually, like if somebody had a mortgage at 3.6%, going back a few years, I had one personally, right? I had 3.6 and I missed all those glory days of the 1.7 to 2% interest rates. But at the same time, if you had been, if you were at that rate, you would have been qualified at 5.6. Correct? So that you should, if all things being equal between what you were earning previously and what you're earning today, your budget should be able to absorb that difference in interest rate because you were qualified at that higher rate. Is that correct?
That's correct.
And do you see any challenges of people still having that?
Absolutely. Like stress test takes up about 23 to 25% of purchasing power, right? So, and it becomes increasingly more difficult because product right now and interest rates are so volatile, and there's so much pressure for rates to come down. So product and suitability is such a focus. It was easy when it was introduced. It was introduced in 2016, 2017, I believe, and it was a standard rate. Like, it didn't matter if you're doing a 1, 2, 3, 4, 5-year term or a variable. You had to qualify at 4.79%.
And now?
And then what happened was the rate started to increase, right? And then we started hitting that ceiling. Rates are coming close to that, so they increased it to 5.25%. And then rates went above 5.25%. So they're just going to say, hey, it's just 2% higher than whatever your rate is.
Right. Just keep it same across the board. Yeah. Right? That was the
2%.
change.
Yeah. So before it was right like across the board. So now, like being a mortgage agent, giving advice, like that suitability piece is so important because, you know, there's tons of anticipation, you know, top economists of Canada are putting all this pressure on rates obviously decreasing. So again, if someone buys a house, right, we go see a house and we say, listen, like, you know, they come to see you, Jerry, I want to buy this house. And you say, okay, well, our goal is to be in it for 3 years, right? Well, I shouldn't really be looking at a 5-year option really, right? Because we want to keep their options after the 3-year term. Obviously, things always change.
Yeah, life changes. Sometimes they go shorter, sometimes they go longer. I've had clients just say, Jerry, this is our forever home.
Yeah.
3 years in, they're calling me, hey, I just saw a house down the street. We swore we were never going to leave, but
yeah,
boy, that's a beauty. Can we go see it?
Yeah.
Right? So that does happen. Life changes.
Yeah. Oh, yeah, it absolutely does.
Do you also find that one of the challenges that maybe people are facing is that they were qualified to be able to afford a higher payment? And, you know, naturally, sometimes people, that difference that they can afford, maybe their lifestyle changed and they're spending it in different ways. And they might have to pull back a little bit in their lifestyle and the choices that they're making. Do you see that as well happening?
Yeah, absolutely. Right. So, I mean, we do a lot of diligence. And if you've ever watched the mortgage process, like we ask for, you know, an arm and a leg, basically on the paperwork side. You know, you go see a car, you go buy a car or apply for a credit card. It's typically easier to take on more debt. Right. And now that we've seen interest rates increase by 300, 400, 500%, and no one's employment has increased by that much, right? But now you're able to like take on additional debt. So yes, there's absolutely buffers in place when you're doing the mortgage application, but like people are, you know, especially with like just the cost of living being so high, people are living on those other like lines of credit cards, even just for daily living. Right?
Yeah, it's nice. Yeah, it's nice when, you know, hopefully people that got a mortgage 3-5 years ago have had a little bit of increase in their wages. But unfortunately, inflation has surpassed wage increases in most people's situations.
Yeah, absolutely.
Right?
Absolutely.
So it's a little reworking of their whole life and plans and where they want to be and really taking a good hard look at that.
Right. And I will say there's not like a one shoe fits all like situation that just kind of helps everyone, right? Like it really takes like, again, that's like doing a proper pre-approval and like meeting and sitting down and having a mortgage agent like actually review all your options and not just some like advising what it is or not just dictating what that best suitability is. Like
right.
You should be sitting in front of someone. They should be able to dictate all your options. And like, what if I stretch out my amortization? Because obviously stretching out your amortization is one thing, but rate obviously too, is you have a better interest rate, then obviously your monthly payment will be lower. So there's different ways that you can try to get over these like short-term hurdles that we're seeing with people that are up for renewal now to make sure that like they can still, like they're not going to lose their homes, right?
Yeah, I think one of the main lessons here today is that, yeah, sure, it would be perfect and easy if there was one solution fits all. It's simply not the case.
Absolutely.
And when that's not the case, you need to turn to experience. And that's what I believe, and I just want to acknowledge you for that experience that you have, Tyler, because you really care about your clients. You know, I love the big banks. I have no problem against the big banks, but there is often a difference between walking into a bank and saying, okay, your renewal, sign here, and going to a mortgage professional such as yourself and getting great advice. So thank you for that. And thank you everybody for joining us today.
Appreciate
We'll catch you next time. Cheers.
it.